All right, well, it's been an interesting week for the markets as we've been talking about all show. But on Monday, stocks finally went into positive territory for the year, and retail investors were partly credited for that strong V-shaped rally off of the March 23rd lows. But Barclays today saying not so fast. Retail investors and Robinhood were not behind the rally. And we have Yahoo Finance's Ethan Wolff-Mann here to break it all down for us. Ethan, what was Barclays arguing here?
Well, so what's really interesting is, as you say, we've had this big narrative that retail has been, a big driver of this boom. And Barclays comes in and, with what they see as the receipts looking at the Robintrack data. Robintrack is this database that pings the Robinhood API every hour to get kind of a snapshot of what Robinhood's investors are doing. And so what they said is that by and large, when Robinhood users get interested in the stock, it does not necessarily do any better, and it often does slightly worse. This is an interesting thing because we've seen a lot of notes coming through from Wall Street and other big investors like Jeff Gundlach saying, talking about the role of these Main Street investors. I always wonder because Robinhood doesn't have that many users. There's not that many assets under management. And you just sort of wonder how much they can push. But even if Barclays is saying this, which seems perfectly legit analysis to me, you wonder about whether there is some sort of other kind of effect, second order effect in that interest that might help drive some of this. Nick Colas of DataTrek told me that you just look at the Google Trends and you can see that a lot of people are interested. But then you get back to the chicken and the egg thing. Is everybody interested? Because the sort of Warren Buffett, fortune cookie, very good advice that, we ourselves often give, to, be greedy when others are fearful, et cetera. All of that is internalized. And maybe that's kind of how we're all just behaving right now, but it's not clear.
Ethan, it's kind of hard not to argue that the reason why we're seeing the crazy moves that we saw in Hertz is because of a lot of investors piling into the stock. That being said, a lot of strategists and market experts have always said that the taxi driver indicator, meaning that if you have a taxi driver asking you about market moves, that's a sort of sign of the top. So in that case, what is Barclays attributing all of this volatility to then if it's not the retail investor?
I mean, that is so true. And I think the one of the big things here is that, an S&P 500 ETF is not the same as, a broad basket of popular hot, mega cap stocks, which is also not the same as something like Hertz. The whole bankrupt stock portfolio of, plenty of things that are just experiencing these huge percentage moves as kind of existential threats face these companies. That actually I think is probably a different story, and I'm actually looking into that as well to see about people trying to use that as they might gambling, which I think is a theory that we saw pop up a lot, and I think a lot of people believe that. People have stimulus money, people are at home. Why not have some fun in the market?
All right, Ethan, thank you for breaking that down for us. Have a good weekend.
Thanks, Heidi. You too.